What's up, guys? Another Trade Genius podcast with Bob and Phil here, as always. So the debt ceiling passed, but in reality, this is a game of chicken between the Federal Reserve and the Treasury, and we're the ones that are going to pay the bill. Let's dive into this video. We'll tell you exactly what we mean.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. So Bob, debt ceiling is raised, obviously short term, great. We're not going to default, but in reality, long term, and I think a lot of our viewers understand the lack of sustainability here, but put it into the numbers here for us.
Yeah, so now that the debt deal is done, we're going to have an additional $2 trillion per year of additional deficits that we have to finance. And that actually starts next week, Phil. So we're going to go to at almost $100 billion more a week that she's going to try to raise in the TGA account. And so there's been a lot of back and forth on what yield is she going to try to go for. And what their hope is that if they can get money that comes out of the banking reserves that are held at the Fed, it's not going to affect asset prices too much. But there's a problem with that thinking. And if you want to throw this chart up here, I think it'll blow people away. So Phil, if you look at that chart, is that she's going to have to roll $5 trillion of existing debt that's currently at 2%, in addition to the $2 trillion she's going to incur between now and then at 5%. So if you take, $5 billion and you add 3% to it, you're looking at $150 billion in additional financing that's going to be added to the national debt. And it's basically a little more than a double of what we've been paying. And so we're reaching a point where we're going to get this acceleration now. And I think if you saw anything is that there's zero appetite in the federal government for any kind of pain whatsoever. So the pain is going to be bore on us is they're going to accept higher inflation, and or they're going to try to do what Japan did, which would also create inflation as well. And it may cause a little bit of a Weimar effect with if you try to suppress interest rates, they're going to force everybody out into really, really, really risky assets, for everybody scrambling for yield. So they're going to impoverish us one way or the other. And I think they're going to probably do both. But right now is a game of chicken, because I think Yellen is thinking, hey, I got all this money short term. I'm just going to wait Powell out, and he's going to lower his interest rates, and then I'm going to be lowering the cost of my, interest of the debt I'm creating. So that's what's really going on here. And it's kind of wild that nobody just thinking the knock-on effect on this, because everybody's just so focused on today. But this is why, I think you and I are pretty bullish 2024 with anything that's hard asset related. We got to get through this TGA lift. And once we get through that, Bitcoin will settle, gold and silver will settle. And I think that's where you're going to be able to make your money. And then also, too, if they do try to stamp down the interest rates, yield curve control, then actually real estate is going to probably come back into vogue, too, because people aren't going to be able to get yield. So they're going to swap yield for asset price appreciation again, and we're going to be right back on the merry-go-round again.
Yeah, so for me, I look at that, and it's I think we have to see, will the Fed maintain the course going into the 2024 maturation of this issued debt? I think they're not going to, Bob. I think that they're going to blink, and we're going to see a cut by then, which I think will probably coincide with the fact that we're probably in recession, well into recession at that point. So like you said, everyone's focused on today, and market's going up a bunch, but none of the broad-based indicators are confirming that hey, we should be totally risk on here, other than liquidity, right? Liquidity said risk on middle of May, right? And it doesn't look like we'll have a risk off signal maybe until next week at the earliest. We're now sitting around waiting to see how Yellen's debt issuance is going to go, and what the net impact is on liquidity. But as far as the broad-based market, That even being said, liquidity eventually will start to roll over because everything that we've looked at, all the data that we've been sharing with everyone on a macro scale is all in deep, deep recession prints right now. And I've never seen it where we just magically ignore those types of statistical data points, Bob.
Yeah, I think they pushed everything to the extreme, and you got guys now that are normally not bearish saying he doesn't see how we get out of the box without a big sell-off. So it's gonna be really interesting to see happen. Well, I think the good news in a sense is that we should start getting a sense for how the market's going to react to it starting next week.
Yep.
And then the week after that, we also have the FOMC meeting. So we're going to get some structure around some of our theses here, and we'll see how it all plays out. And then from there, we'll be able to, start working some trades.
Yep, agreed. All right, guys. Well, that's going to do it for this episode. Let us know your thoughts on the debt debacle that we're in. Like Bob was mentioning, 5 trillion maturing by 2024. Is the Fed going to just plow into that maturation with 5-6% Fed funds rate? We kind of don't think so, but let us know what you think. We'll see you on the next video, guys. Please hit like and subscribe, smash that notification bell and set it to all if you can. Also check out our specials at tradegenius.co. We'll see you on the next episode. Take care.
Trade Genius.